Good morning, everyone. I'm delighted to be here this morning to participate in this annual conference of the Bretton Woods Committee's Future of Finance Forum. What I propose to do is to talk on financial stability. I have a prepared speech which I would by and large read out, but it will be uploaded in the Reserve Bank of India website. So I may be skipping certain portions. But I think, as was just mentioned, financial stability has been a major challenge. And I would say, the last 5 years, from the point of view of individual economies, the biggest challenge, apart from the biological, the challenge from the virus which all of us faced, I think it had a concomitant effect on the issue of financial stability. And COVID, then we had the war in Ukraine, then we have continuing geopolitical crisis, and then we had what was alluded to, the banking sector crisis felt in Switzerland and in the United States. So it has been a very turbulent period of last 5 6 years. And this conference in particular, I am delighted to see that it brings together leaders and experts from public and private sectors, multilateral institutions and think tanks to deliberate on important issues of financial stability together with technology. This comprehensive horizon scanning can enrich decision making and help fashion strategies for exploiting opportunities and managing risks and building future resilience. Against this backdrop, I propose to focus on global financial stability, the entire landscape, and the evolving balance of risks and opportunities beyond the current macroeconomic environment. Let me first focus on the current conditions. The global financial system has exhibited remarkable resilience in weathering several high impact shocks in the recent period. While global economic activity and trade have largely withstood the downside risks, the last mile of disinflation has proved to be challenging, giving rise to financial stability challenges. As market expectations about future course of monetary policies realign with policy guidance from central banks, the prospects of hard landing appear to be receding. This is reflected in most of the forecasts which suggest that near-term prospects are improving, notwithstanding the persisting uncertainties in the international economic and financial environment. Macro-financial health has been shored up by stronger balance sheets of financial intermediaries and supportive and even proactive micro and macroprudential policy responses. More recently, however, the implications of monetary policy divergence among countries are beginning to unfold, especially in the form of exuberance and sudden sell offs in financial markets. Together with the recent unprecedented IT outage globally, these developments have shown how risks to financial system can materialize on a global scale and sometimes very quickly, as in a few banks in early 2023. These facts have brought home once again the importance of crisis preparedness and robust business continuity plans. Nelson Mandela had once said, and I quote, "After climbing a great hill, one only finds that there are many more hills to climb." While several short term risks appear to have receded, the global financial system continues to face heightened uncertainty from the outer term outlook. Some of the risks are well known and well acknowledged, but other risks are just emerging or are lurking in the background. As macroeconomic conditions diverge in different regions of the world and policy responses get increasingly unsynchronized, spillovers to advanced and emerging economies alike are getting amplified. In this highly uncertain scenario, policymakers and financial sector regulators have to work with renewed urgency to buffer economic activity and financial sector from unforeseen shocks. A flexible and robustly equipped regulatory architecture in the financial sector would be essential to stay ahead of the curve and minimize the risks. Macroeconomic policymakers and other stakeholders must also be quick to adopt a forward looking approach to navigate the difficult bends and turns on the road that lies ahead. Employing sustainable business models and judiciously harnessing full potential of technological advances will be the cornerstones of this approach. I would now like to turn to the overall macroeconomic outlook of the entire global macroeconomic situation. The resilience of global economic activity in the first half of this year, that is 2024, prompted a repricing of policy paths by financial markets. Accordingly, a better balance in the risks to outlook began to emerge. Output path, div- Output path divergences started narrowing across economies. Cyclical effects also started waning. Going into the second half of this year, that is 2024, while global growth appears to be steady, it remains subdued by historical standards, with disparities between regions. Some emerging market economies, that is EMEs, continue to demonstrate resilience and adaptability, while others, mostly in low-income countries, that is LICs, are still in a vulnerable situation. A few advanced economies are also at the risk of facing a slowdown. In its early July 2024 World Economic Outlook update, the International Monetary Fund presented a cautiously optimistic outlook for the global economy. In its view, varied momentum of activity is narrowing divergences across economies while world trade is firming up. The growth of global trade is expected to align with the pace of global growth in 2025, thereby keeping the trade GDP ratio stable over the medium term. At the same time, however, cross-border trade restrictions have increased amidst rising shipping costs and logistics disruptions. Overall, the risks to the outlook are judged to be balanced, although in the near term they weigh on the downside. Let me now touch upon some of the salient risks to the global macroeconomic outlook. First, the momentum of global disinflation is slowing, warranting caution in easing monetary policy. The persistence of inflation, particularly in the services sector, poses a significant risk. Fueled by a combination of elevated wage growth and constrained productivity, these factors are placing the balance sheets of financial intermediaries at risk from recognized and unrecognized valuation losses. The stickiness in inflation could delay the return to price stability, which in turn increases external fiscal and financial risks. In such a scenario, monetary policy management by central banks has to be prudent and supply side measures by government have to be proactive. Second, the unprecedented high levels of debt characterize the global economic landscape. It has reached a level of US dollar 315 trillion or 333% of global GDP according to the 2024 estimates of the Institute of International Finance. At these levels, the debt overhang poses significant spillover risks to the emerging market economies. In particular, the low and middle income countries they are very vulnerable. Coexistence of high levels of debt and elevated interest rates can feed a vicious cycle of financial instability through impairment of government and private sector balance sheets. Fiscal deficits and net accretions to debt stocks are higher than the pre-pandemic levels. There also there are also uh, there are also uh, there are also there is also little scope for improvements in fiscal aggregates, given the fact that 2024, the great election year, is seeing 88 economies going into their own election cycles. Needless to emphasize that fiscal consolidation has become even more crucial than before for achieving the last mile of disinflation. For emerging economies, such consolidation could also lessen the incidence of severity of capital flows by improving their ratings. The third point which I would like to highlight in terms of the risks to global macroeconomy, that it's as follows. The increased and persisting geopolitical risks can further add to the heightened risk aversion among investors, prompting flights to safety and volatility in asset prices. Countries at the receiving end of such a situation have to build their own buffers and strengthen their resilience through appropriate policy responses. Fourth, with trade policy uncertainty reaching exceptionally high levels, the risks associated with protectionism and unilateral trade policies threaten to undermine the multilateral trading system. Such a scenario is filled with potential to create a protracted period of economic fragmentation and reduced global growth. Revival of multilateralism and coordinated policy action can mitigate the severity of the situation. Fifth, climate change related adverse weather conditions are imparting considerable uncertainty to both growth and inflation trajectories. Inward looking policies, including trade distorting measures, could compromise the ability to tackle global challenges like climate change. Climate commitments made by nations must be fulfilled while adhering to the widely accepted principle of common but differentiated approach. All these risks are getting interdependent, they are getting increasingly interdependent, as changes in the profile of any one of the risks usually shifts expectations relating to the others. The need of the hour for policy authorities and central banks is therefore to remain agile and craft appropriate forward-looking policy measures, forward-looking policy responses and structural changes to overcome these risks. I would now like to turn to the issues relating to global financial stability risks. Let me outline a few of the global financial stability risks. First, global financial markets have displayed resilience in recent months with equity and bond yields rallying, volatility remaining low for most of the part and narrowing of corporate bond spreads. But there has been a sharp increase in prices of relatively riskier assets. While stocks have been supported by strong earnings, the narrowing of corporate spreads has coincided with rising episodes of corporate defaults. The current scenario also differs from the past monetary policy tightening cycles when markets displayed risk-off sentiments and prices of riskier assets declined. To the extent that valuations are currently stretched, sudden shocks could precipitate stress that spreads contagiously across financial market segments through sell-offs and bandwagon effects. Second, market expectations of higher interest rates in the United States, along with other factors, had kept the US dollar strong. The generalized global risk-off environment had increased the volatility of capital flows for many emerging markets. Further, a strong US dollar increases debt service burdens and inflationary pressures on the emerging market economies. Now, to what extent this scenario will get impacted would depend upon the quantum and timing of the policy pivot by the US Fed following their recent pronouncements to this effect. Third, the proliferation of non-bank institutions in financial intermediation may create risks to financial stability due to their size, complexity, and interconnectedness with domestic and global financial systems. In recent years, a number of vulnerabilities have emerged in the NBFIs in advanced economies, contributing to periods of market dysfunction. Hidden leverage and liquidity mismatches of these institutions can amplify shocks and propagate strains throughout the financial system. Fourth, private credit, which is somewhat interlinked to the NBFI credit. Private credit has also grown fourfold over the last 10 years. It is now a major source of corporate financing among middle market firms that have low or negative earnings, high leverage, and lack high quality collateral. Proliferation of these asset class, along with intensifying competition with investment banks on larger deals, may shift supply demand dynamics and result in poorer underwriting standards. As a consequence, the probability of credit losses can rise and make existing risk management models obsolete. The rapid growth of private credit, their increasing interconnectedness with banks and NBFIs, and their opacity creates vulnerabilities that could become systemic. Regulators world over need to give a closer look to these developments and come out with necessary guardrails. Fifth, stress in the global commercial real estate, that is the CRE sector, also needs to be watched closely. Banks exhibit high sensitivity to expected and unexpected CRE losses due to relatively high commercial real estate coverage ratios in their individual loan books. Further, liquidity squeezes can also materialize for banks with large CRE exposures, as short sellers may target them and investor confidence may slip further. As I said earlier, staying alert and undertaking forward-looking regulatory measures ahead of the curve can contain the risks to bank balance sheets and protect systemic stability. Now, I would now like to turn to the issue of higher for longer interest rates. The interaction of financial conditions with monetary policy can present overwhelming risks to financial stability. The synchronized monetary policy tightening in the last couple of years across the globe is gradually giving way to monetary policy divergence in 2024. While quite a few central banks have started trading the path of rate cuts on account of recession worries, many still continue to maintain restrictive stance and refrain from reducing policy rates so as to break the back of inflation persistence decisively. So there are other central banks which are either increasing the rates or are maintaining status quo. The higher for longer interest rate environment did bring forward financial stability risks, as seen in March 2023 in certain advanced economies. Tight financial conditions impacted balance sheets of banks in these jurisdictions. Market expectations of rate cuts are now regaining momentum, especially after indications of a policy pivot from the US Fed. But adverse spillovers from the higher for longer interest rate scenario remains a contingent risk. On the other hand, there are central banks which naturally and justifiably remain averse to premature loosening of policy before inflation has been durably reined in or aligned with their targets. Central banks in these countries need to remain watchful of their domestic inflation growth balance and make policy choices. The other major risk that lies ahead of us is geopolitical risks. The resurgence of geopolitical risks and their persistence pose high risks to financial stability given their high speed of transmission and multifaceted exposure of the financial sector. Geopolitical risks may emanate not only from wars, terrorist attacks, trade disputes, and political gridlocks, but they can also arise through supply chain strains, technology decoupling, cyber attacks, and weaponization of finance. The geopolitical risk index has spiked sharply in 2024 amidst increases in trade restrictions and financial sanctions, reversing the gains from several decades of global economic integration. Geopolitical risks are imparting heightened volatility to capital flows and asset prices. They are even impacting bystanders or countries which are not directly involved in the conflicts. These developments often result in strains on the international monetary system, undermining the efficiency of global payment systems. Even as we reap the many benefits of increasing financial integration, it is evident that the contagion risk from geopolitical events can no longer be ignored, especially in the context of transactions in forex, equity, and debt markets, as well as the banking system. Geoeconomic fragmentation is weighing on medium-term outlook for global growth. This can delay the convergence of emerging and developing economies with better living standards. In addition, geopolitical tensions in the past have generally been associated with volatility in crude oil prices and disruptions in supply conditions. With their negative feedback loops, they aggravate the stress on the real economy and the financial system. While it may not be possible to completely insulate from such risks, it is important to deal with them through systematic monitoring, building buffers, devising contingency plans, and fostering multilateral cooperation. Of course, at the current juncture, we have to note that the crude oil prices seem to be moving in the opposite direction. They are coming down, which is quite different from the past experience. What I have done here is to go by the past experience, but today what is happening with regard to crude prices, as you are all aware, are quite different. Now, before I conclude, let me just touch upon some of the opportunities. While talking about the risks, I also want to touch upon certain opportunities. As we navigate these risks and challenges, we need to recognize that there are also huge opportunities that lie ahead of us. Current challenges open pathways for economic resilience and a stronger global outlook if addressed collaboratively and strategically. Let me highlight some of the opportunities. First, impending monetary policy pivots with strong probability of soft landing provides hope that global inflation could be on a sustained downward trajectory. This would open up space to strengthen foundations of growth in an environment of benign input costs and revival of the labor market. For emerging market economies in particular, this possibility offers opportunities to capitalize on robust fiscal, monetary, and financial policy frameworks to exploit the potential to attract investment and accelerate sustainable growth. This is also an appropriate time to consolidate the gains from post-pandemic rebound with deeper structural reforms in both product and factor markets. Second, despite the uncertainty surrounding geopolitical outlook, the latest projections suggest that a turnaround in world trade is taking hold. This offers another engine for economic expansion. Third, it is important to acknowledge the role that finance will continue to play in global growth story, particularly for the emerging markets such as India. This is an opportune time to enhance the breadth and access and efficiency of financial markets while also protecting consumer interests. A forward-looking approach would require developing regulatory sandboxes, fostering collaboration with innovators, and ensuring the integration of new players into the regulatory framework without compromising prudence and financial stability. Fourth, digitalization has been a game changer, driving empowerment, entrepreneurial innovation, productivity, and also enabling an irreversible transformation of the economic landscape. Leveraging the digitalization channel has the potential to bring in improvements in the field of financial inclusion, formalization of finance, and enhancements in cross-border payment systems. Fifth point relates to climate change. Climate change, while being a serious risk, being a challenge, also gives us another critical opportunity for innovation. Quest for new climate technologies and harnessing them can be instrumental in fostering energy independence, especially for developing countries. Climate smart financial solutions such as issuance of green bonds also provide avenues for private sector involvement and engagement. Sixth, reforming the international monetary and financial and reforming the international monetary and financial system is crucial for ensuring global economic stability, fostering growth, and mitigating systemic risks. The current system, while having supported decades of economic expansion, is increasingly challenged by imbalances and inefficiencies, including the dominance of a few countries in global trade and finance. While reforms should address these imbalances to enable greater inclusion of emerging economies in global financial governance, they should also focus on strengthening global financial safety net. Now, as I proceed to conclude, let me just say about India. It is there in the text. I don't want to read it out. A few words about the Indian economy. While the macroeconomic outlook for India for the current year, we have projected a growth rate of 7.2% of the GDP. The average annual growth in the last 3 years in India was 8%. Average annual growth. This year, Reserve Bank's projection is 7.2%. Financial stability, despite the shocks that we witnessed from many external developments as well as domestic challenges, mostly emanating from weather, certain severe weather-related events. The financial stability has been maintained, and the balance sheets of banks and the non-banking financial lenders, that is NBFCs, are at their best. So far as inflation is concerned, immediately after the outbreak of the Ukraine war, our consumer inflation, which is our on which we target, our target is 4% plus minus 2%. That suddenly spiked to 7.8% because the energy costs went up, the many edible oil which we import from that region went up, prices of wheat went up internationally, although India is self-sufficient in wheat. But when international prices went up, naturally our domestic prices also went up. So 7.8 was the peak of the consumer inflation immediately in the aftermath of the Ukraine war. And thereafter, we took several monetary policy tightening measures, liquidity tightening, rate hikes, etc. And the inflation has been brought within the target band of 2 to 6%, but our target is 4%. And over the last several monetary policy meetings, we have been reiterating the importance to stay the course and not get carried away by some dips in inflation. And I am happy to report that the inflation that India recorded in July was 3.6%. The number was 3.5. It's been revised yesterday to 3.6%. And the August inflation data, which was released last evening by the National Statistical Office, is 3.7%. So for the last 2 months, that is July and August, our inflation is 3.6% and 3.7% respectively, below the target of 4%. But there are challenges, and we are acutely aware of that. Let me now just conclude. I think I have taken more time than was allotted to me. India's vision of global progress emphasizes international cooperation that is people-specific, ambitious, action-oriented, and decisive. India's G20 presidency in 2023 and its continuing contributions thereafter reflects India's vision of the world being one earth, one family with one future. These priorities include strengthening the multilateral development banks to address shared global challenges of the 21st century, achieving financial inclusion and productivity gains through digital public infrastructure, debt resolution for lower and middle income countries, and financing the cities of tomorrow, among many others. In conclusion, let me say that India remains committed to reshaping of the global order in the decades ahead for the betterment of the world. It's now time for everyone to work for one future for the entire mankind. Thank you. I'll stop here.
Please.
There?
Yes, please. So I'll start out with a couple of questions to warm up and then open up to the audience here. So thank you, Governor Das. You have really steered through some remarkable times, and you mentioned some of the challenges and developments just earlier on, let alone COVID-19, surge in interest rates in the US, faster surge since the 80s. You mentioned the floods, the war, and so on and so on. What are your sort of key points and your key takeaways, as well as advice you would share as you steered through that?
Well, I mean, I don't want to advise anybody because everybody knows their job. But I think looking back, what really helped us was, to keep our eyes and ears open and to be nimble footed, take action, try to be as proactive as possible, try to see a crisis ahead of, ahead of actually it happening. I'll just give you one example. When we got the news of COVID, setting in, uh, and the government government sensitized us. In fact, the highest authorities of the government did speak to me, and in they told me specifically what is government's understanding of COVID, and they just told me that, look, this is how it is likely to happen. So one of the first things that we did, very unusual, was to issue an alert to all the banks and non-banking finance companies about cyber attacks, possible cyber attacks. It looks unusual because when there is a crisis, this is the time when, internationally we all are confronted with problems of, attempts to hack into the cyber security systems and the IT systems. So one of the first things we did was to sort of alert the banks and the NBFCs to take, to increase their cyber security measures. We had a meeting with the CEOs of banks. Then we set up immediately before, India had announced a lockdown, we set up a Biobubble facility to ensure that all money market operations, all money market platforms which are operated by the Reserve Bank, they continue to operate without any disruption. So in one of our data centers was converted, was, sanitized, and it was converted into a, a Biobubble facility was created there. Close by we had a hotel, and put about 200 of our staff and service providers there to sort of see that the money market operations, they do work. We set up immediately a parallel small office in one of our guest houses in Mumbai. Now these are not finance related measures, but these are administrative measures to ensure, just to example, to illustrate how, one needs to be proactive. So we developed a parallel office facility and just kept it ready, just in case we have to close down our big 25-storied building in Mumbai because of COVID. And it did happen. Number of people got infected, so we had to close down that entire office for a period of almost 2 months. And that entire 2 months we were operating, just few of us from that parallel office. We were all coming there, and no support staff was there, only the governor, the deputy governors, 4 of them, and a few senior officers. And of course, everything was online. Policy measures also, the idea is to, what we adopted, the approach was to try and see what are the challenges that can originate and take advance measures. I think this is something which helped us. Second thing which I also would like to highlight is, during this entire period, the coordination we had. On the one hand, our coordination with the banks and the financial institutions, I myself was having video meetings with the CEOs of major banks almost every fortnight. I was talking to them, having a video meeting with their CEOs, trying to find out what was the issue and understanding the problem and their perception of the challenges. So we kept on injecting liquidity whenever it was required. First, we injected a generalized kind of liquidity. Then we found that the liquidity has to be targeted, because we are giving liquidity but it's not reaching the targeted sectors. Like for example, the small lenders, the small non-banking lenders who could face liquidity challenges. Then we went in for targeted liquidity support through the banks to those small entities. Then again, when we found that we are giving liquidity but there is no appetite in the market, because the financial institutions as well as the end borrowers, they were all, because the end of COVID was not known to anybody. So nobody wanted to add to his loan book. Nobody wanted to add to his debt burden. Then that was the time we prepared an emergency credit line facility and suggested to government that, look, liquidity is not going to solve the problem. Government has to give some kind of a guarantee to, to the banks to enable them to lend to the people, and to the people also, it will give them comfort that, well, if I'm not able to repay, the government will, stands guarantee. So I'm not going to be permanently disabled. So therefore, I think, coming back straight to your point, the idea is to sort of remain, try to see the crisis before it materializes, and try to be as quick and as proactive in taking measures, and finally maintaining good coordination with the government also. That does help. I mean, we need to talk to each other. Sometimes, central banks function in a, in a different, in a different, you would know, all of us do. We are so, we are so possessive about our autonomy, which is necessary, which is necessary. But I think in situations
Almost like a bubble.
well, but in situations like this, and even in normal times, it's necessary to sort of have close engagement with the government also, because the government needs the central bank needs the government also equally. For many amendments and changes in the law, we have to go back to the government.
Yeah. So you just mentioned 7.2% growth outlook, 8% on average, inflation 3.6, while you want to be somewhere between the 4 and 6, 2 and 6 that you were mentioning before. You've remained very disciplined in terms of monetary policy in India. How do you think about growth going forward and policies in the future? And what is sustainable growth? What are those levels, especially with the rise and focus on India? I can only mention this because you have Ginny Young, who's the CEO of Singapore and Southeast Asia for us, as well as Miki Doshi, and they presented to the board this week our India strategy, because there's a lot of emphasis on India. So how should investors, businesses think about India, the growth potential, and the monetary
I would be
policy?
curious to know what your internal team has projected to the management.
We will follow up. We will follow up. We'll come and follow up.
Yeah, maybe bilaterally you could tell me what is your understanding and what is your projection. But on a serious note, I think India's potential growth today, I would say it's about 7.5% plus. This year we are recording we expect, at the end of the year to record 7.2%. The first quarter number has come at 6.7%. So some people, some analysts appear to be a bit skeptical. But actually, first quarter, what happened is that the government expenditures were low. That is because the elections were taking place, and the elections in India stretch over a period of 2 months, and exactly in the first quarter. So government expenditure was low. Both central and state government expenditures were low, and that really pulled down the GDP. But all the other drivers of growth, whether it is consumption, it is investment, or in the supply side like agriculture or industry or services, I think all of them have recorded 7% plus growth in the first quarter. India's potential growth is high because of the several structural reforms which have been undertaken by the government over the last 8 to 10 years. And among them, the major ones I would like to list out. First is, of course, they have a monetary policy, inflation targeting framework. Then the goods and services tax reform that has induced a huge amount of efficiency into the economy, the goods and services tax. Then for resolution of the stressed assets of the banks, the insolvency and the bankruptcy code. So like that, number of reforms have been carried out over the last 10 years, which have added to the overall efficiency of the economy. And government's emphasis also on developing physical infrastructure and easing the the facilitating the ease of doing business. There is still, under which I feel at the local level, at the state government level, there still is a lot of distance to be covered. But I think at the central government level, at the Government of India level, a lot of measures have been taken. So therefore, physical infrastructure development, digital infrastructure development, all of these facts have, they have injected quite a bit of, not quite a bit, a whole lot of, I would say, efficiency into the economy. So as we see India's potential growth at one point, our own RBI projections about 2 years ago, we had said 6.5 to 7% is what we had projected. But today I think we are looking at a potential growth of 7.5%. In fact, elsewhere in the domestic forum, I have said that India is on a path towards 8%, but taking a more conservative position, I would like to say that it's around 7%. And we should be, India should be able to maintain that kind of growth in the, in the next few years.
So maybe I'll take a couple of questions that are coming in from the audience. People have already used the QR code, so very tech-savvy group here. What is the biggest risk to India's ability to maintain its current admirable growth rate over the next decades, which sort of is a good follow-on?
Biggest?
Risks.
I think biggest risk would be, one is the weather-related events. What happens is that the intensity and the frequency of unusual weather developments like a cyclone or a flood, these things have become more frequent and more intense. And when it happens, unlike in the past where rural infrastructure or the rural areas were affected, today I think urban flooding is a major challenge. That completely upsets and affects not only inflation, but it also affects industrial activity, it affects services sector activity. So that is one major thing which we have to be we have to keep in mind. The second thing is the external shocks, because all said and done, India is still we still import about 75-80% of our energy, the crude oil. Crude oil from, we do import it. And internationally, if the crude oil prices go up, it puts a lot of pressure not only on our current account deficit, but also on the fiscal deficit of the government, on domestic inflation. So that is the second thing. And the third thing is, I think, continuing geopolitical tensions and the trade restrictions and pressures in the external markets. India's merchandise exports have improved, but not the way we expected them to improve, because of external demand is not as robust as it was. But on the contrary, services exports have really picked up. So if external conditions and if external demand compresses, but the WTO as well as the IMF, they expect this year the world trade to grow, and also in the next year they expect world trade to grow, although marginally. But that also is a pressure point about which we have to be careful. So these are the 3 points I would like to mention.
Well, we're running out of time and we probably could spend the entire day on India. One last question from the audience, which relates to the rupee. It's been fairly stable, yet down year to date 1%. How should investors think about the rupee?
Well, what investors think about, I think I would like to hear inputs from people like you.
Let me rephrase. What do you think about the rupee going forward?
I think the rupee has been very stable, and a section of the market or some sections of the market, they think that Reserve Bank has got drawn certain lines.
Yes.
And Reserve Bank doesn't allow the rupee to depreciate beyond that. I would like to say that it is not so. Our philosophy and our approach is to to ensure orderly evolution of the exchange rate. Either when it is appreciating or when it is depreciating, we want to prevent excessive volatility within a short period. We want a very orderly kind of depreciation or an orderly appreciation. The second, and we do intervene in the market with this approach. The second thing which is very important is that India's macroeconomic fundamentals today, unlike 10 years ago, India's macroeconomic fundamentals are very strong. And naturally, when the economy is becoming stronger, it will get itself reflected in the exchange rate. The rupee has remained stable for the last, I would say, more than one, from the entire 2023 and 2024. The exchange rate the depreciation of the rupee vis-a-vis the dollar, the volatility has been the minimum. In fact, I would say throughout 2023 and 2024 till now, among the emerging market currencies and also including some of the advanced economic currencies, The volatility index of the rupee is the lowest,
Yes.
is among the lowest, and rupee has been fairly stable vis-a-vis the US dollar over the last 1.5 years. And that's a reflection of the macroeconomic stability, macroeconomic strength of India. It's a reflection of, naturally we do intervene to prevent excessive volatility. And third, we are experiencing good inflows. Good flows are there. India has now been included in the bond indices, global bond indices. That also is resulting in lot of inflows coming in. The FPI inflows this year in particular have been very robust. FDI inflows, although less than last year, are still quite steady. So a lot of inflows are happening, and I think today India has emerged as a destination for international investors. So therefore, from my experience, I can say that we get so many visitors. Normally, they don't come to the central bank, but these days many of them come to the central bank. And the kind of people who are coming to, at the CEO level from all over the world, at least I can say on the basis of my own experience that there's a lot of investment interest in India.
So with that, we will conclude this session. A big thank you to you, Governor Das. Thank you. Thank you.
Thank you.
Thank you.